colleagues that this great session called Marginal and Absorption Costing has started. Absorption Costing. The session has started. So we shall write a few things as we wait for this handout to be sent. And this is what I want us to write, my great students. Yeah. That marginal costing is an approach. Marginal costing is an approach. Marginal costing is an approach used by some businesses. Used by some businesses that focuses only on the variable cost per unit, comma, treating fixed cost as period cost. I repeat, that marginal costing is an approach used by some businesses that focuses only on variable cost per unit, comma, treating fixed cost as period costs. Yeah, so whenever, ladies and gentlemen, we talk about valuation of inventory under marginal costing, valuation of inventory under marginal costing, I'll be calling this one here MC. This is how we shall always be valuing our inventory. So we have here material cost. We have labor cost. We have variable production overhead. So this under marginal cost will be our inventory cost per unit. Inventory cost, yeah, or production cost, yeah, per unit. So anytime you want to value our inventories, you will always value inventories. If it's marginal costing, we cannot bring in fixed cost. So if it is marginal costing, in terms of inventory valuation or valuation of the units you have produced, we shall only be considering three costs. We have material cost, which is variable, yeah, labor cost, and then we have variable production, what here? Overhead. Variable production overhead. Those three will automatically give us what we call inventory cost or what we call production cost per what here? Per unit. Question. We go straight away to a question. And now the question is on your handout, which this lady now has gotten, right? Thank you so much. Please share it. In this great group of ours, where I've never seen you guys discussing anything to do with the MA. In that group, I've never seen you discussing. Or what do we want to do this group for? So if you scroll that handout, you'll be able to see where they have given us example 1, marginal costing application. Yeah, this is on page number. We have pages here. Page number 35. Page number 35. Page number 35. Yeah, the one written on the book itself. You know, there will always be two types of page numbers. So there is one written on the book itself. Page number 35. You will be able to see at the middle there where they have given us a question to do with the marginal costing application scenario. XPLC produces one product known as what here? Desks. Are we there? Desks. And then we have, sorry. I think I took you a bit faster. We have direct materials for a desk, 4 kilograms each going for 3 per kilogram. We have direct labor, 4 hours each going for 2 per hour. Then we have variable production overhead, fixed production overhead, average production, selling price per unit, variable selling cost. Then we have fixed selling cost, 2,000. Then you can see, ladies and gentlemen, the quantities We have the month of January. Month of January, we produced how many units? Have you gotten the question? No, eh? Please show them where the question is. If you can even stand up a little bit, you are my assistant teacher here. Last page. Yeah, please, you can stand up a little bit and move around. I will ensure that they pay you some fees, eh? All right, the online students, you can straight away take screenshots, eh? Screenshots. So the month of January, we produced how many units? 11,000. And sold how many? 9,000. So is there somebody who is able to see closing inventory? Because we produced 11 and we only sold 9,000. So please, let's write this down. Because you mess up in this quantity movement, you get a zero. You get a zero, and then we'll be cussing wherever you are that you know these people now, they want to build another tower using my money. It is you who never got the concept right. Now they want Castle Tower 2. Using my money, they shall never use your money to build towers. We shall clear. We shall clear. So we have here inventory. Yeah, it's very important for you to get inventories. So we have here opening, inventory. We have a production. We have sales. Then we have closing inventory. Closing inventory. Yeah. So we start with the month of January. So January, I can see evidently that there wasn't any opening inventory. In January, we did produce 11,000. Is that okay? And then we sold how many from the question? So then how many were left as closing? 2,000. We go, ladies and gentlemen, to February. February. Who can tell me, what do you think will be the opening inventory for February? 2,000, yes. What we had here as the closing stock in January becomes the opening stock in February. So 2,000. From the handout, are you able to see how many we produced in February? Are you able to see how many we produced in February? How many do we produce? 9,500, isn't it? 9,500. 9,500. Yeah. So in this case here, the quantity that was available for sale will be 11,500. Because getting quantity available for sale, you look at what you started with plus what you produced in the period. How many do we sell? Are you able to see the units sold here? 11,500. Meaning what about closing inventory in February? 0 or dash, yes, 0 dash, like that. So if you get this wrong, your entire marginal costing P&L will be wrong. Your entire absorption P&L will be wrong. So then they want me to prepare, number one, a cost card using marginal costing. Let's prepare a cost card using marginal costing. So mention there cost card into brackets MC. I'll wrap this, but I expect when I start doing my P&L, you'll be able to remind me these figures, eh? Yeah, if you don't remind me these figures, I know the punishment that will be meted unto you guys. Because already you have them. So now we do a cost card. We are doing a cost card using MC, where MC stands for Master of Ceremony. No. Marginal what here, somebody? Costing, isn't it? So cost card, if it's marginal costing, we are only looking at what here, variable costs. And the variable production costs for that matter. Not all variable cost, but variable production cost. You can even write in brackets, variable. We shall be looking at variable production costs. Variable production costs. Variable production costs. So then we start with the material cost. So material cost, I can see how many kilograms of these materials. 4 kilograms, isn't it? Yeah, today, for whatever reasons, I don't know which reasons are really those. My online students are not as active as they are. Yeah, today it's only physical students that I'm seeing being very active. So direct materials, you can see 4 kilograms, each at 3. So 4 kilograms, each at 3, isn't it? Which gives me how much here, somebody? 12. Then of course, these materials cannot, in this case here, convert themselves. We need laborers. We need overheads, isn't it? So come and give us labor cost. So labor cost, I can see 4 hours. And each hour is how much? Each hour is 2. Each hour is 2. Each hour is 2. Now, ladies and gentlemen, that gives me 8, isn't it? From there, we are very categorical regarding the overhead, that we are only picking the variable production overhead, isn't it? So variable production overhead is how much? 5 per unit, isn't it? Yeah, 5 per unit. Per unit. And that is it. If it's marginal costing, our cost card is over. Yeah, this is the marginal costs, the marginal cost per unit produced. Marginal cost per unit produced, which will end up being how much here, somebody? 25, isn't it? Now, ladies and gentlemen, the trick, thank you so much, online ninjas. I can see now you are really fighting. Remember, if you look at your past papers, because it's a past paper question that I brought here, you'll be able to see somewhere down here, yeah, after direct materials, we have direct labor, we have variable production overhead, we have fixed production overhead. Those ones cannot come to our statement here, because this is marginal costing, which is variable production costing. Then we have average production, yeah. Then we have selling price, and then you can see down there we have variable selling cost. So can we bring this variable selling cost to be part of inventory costs? No. Remember, our inventories, we are only costing them up to the time we produce them. It is only production expenses that can only go to our units here that we produced and the inventory. Any selling expenditure is post-product. Yeah, that is post-production. It can never come here. So here we are only looking at taking, in this case here, production cost. Which production cost are we looking at? We have material cost. We have labor cost. And then we have variable product. If you have variable selling, those are not within our purview here. All right. So I've done part 1. Then we look at part 2 of this question. So part 2 of this question, my good students, what do they want me to do? So part 2 of this question, they want me now to prepare a cost card using absorption costing. So under absorption costing, now you absorb everything, production. Yeah. So absorption costing, what do we do with absorption costing? What we do about absorption costing, I shall copy everything that I have here, everything. Yeah, I shall copy everything that I have here apart from this. So number 2, I'm doing a cost card this time round using what we call absorption. Remember, your examiner at times will use different words. Instead of using absorption, your examiner can easily use full costing. Full costing. So remember, under full costing, we shall consider variable production cost and the fixed production cost. So in this case here, you must come and introduce, you must come here and introduce the fixed production overhead, fixed production overhead. So you must introduce the fixed production overhead. So, and you need to be very fast like myself. I mean, you can see how fast I've written, Yeah, I've just finished writing. And you are the Gen Zs. Yeah. So remember, you can't take my shortcut. Yeah, karibu. You can't take my shortcut. This is number 2, cost card using absorption, or what we have also called in the past, full what here? Full costing. Is that okay? Full costing. What we have also called full costing. Full costing. What we have also called full costing. So then I would request you guys to give me the number to write here. Give me the number to write here. 1,000? 20,000, isn't it? Are you not seeing that 20,000 to be very high in comparison to the, there are things you can write in an exam and then you get to know that I'm wrong, isn't it? I mean, oh, so we take like these others are in thousands. Now let me hear from the online students. So online students, please tell me, and don't take me to be harsh when I respond like that. I'm a cool guy. I'm a cool guy. I'm a cool guy. You see, all these are on a per unit basis. Even variable, we said variable production overhead per U. Actually, the one who mentioned that per unit. So even this fixed production overhead must be for 1 unit, isn't it? The 20,000 is for a whole month. 20,000 is for a whole month. And within that month, you expect to produce how many units? So you can see fixed production overhead is Kenya shillings 20,000 per month, isn't it? And in that month, the average production per month is 10,000. So then I will calculate what we call OAR, overhead absorption what year? Rate per unit, which will be 20,000 divided by how many units? Somebody? 10,000. So you take the total fixed overheads over expected production. Over expected production to make it for 1 unit, which in this case here gives us 2. The 20 you are guessing was almost there, right? Yeah, so we have 2 there. So then come and give me the full cost per unit. Give me the full cost per unit. Per unit. 27. Thank you so much. 27. Let me ask you a question. I can see down here, I have fixed selling cost of 2,000 per unit. Can I bring this one here in terms of inventory valuation? Anything selling, that will be post-production. That can never be featured anywhere under production. Because once in this case, ladies and gentlemen, we have been able to start selling these units outside there, they are far from our warehouses. Remember, in the warehouse, we only value production cost and then inventory. Once they're outside there, then we talk about profit and loss account. Yeah, they are not absorbed during production. Any selling expenditure can never be absorbed during production. Can never be absorbed during production. Thank you so much. I hope you've been able to write that statement in your mother tongue, that all selling, distribution, marketing costs can never be absorbed. Units produced can never be absorbed to units produced. All those selling costs, marketing costs, distribution costs, they can never be absorbed to units produced. They can never be part of cost of goods sold. In short, they cannot go to the trading account of our P&L. They can't go to the trading account of our P&L. They are periodical costs. These are those expenses which will be lumping under what we call expenses later. Thank you so much. I can see you guys are really informed. You are really informed. Now, look at number 3 of this question. The moment we finish this number 3, we go home, where you guys laugh, isn't it? Prepare profit statements for January and February using marginal costing and what here, somebody? Absorption costing. So I would want to prepare for both of them. Yeah, so profit and loss statements. Profit and loss statements using marginal costing. So we have here P and L, marginal costing. So we have January. We have what here, somebody February, like that. Yeah, you can do 1 month at a time, but you see at times, ladies and gentlemen, because you're going to do in this case here a marginal and absorption, it can become very hectic. Doing January, you finish, and then February, it can become very, very hectic. All right. Great students of mine. We start with sales. Sales. How do we get sales? It's price times quantity sold, isn't it? price times quantity sold. So from the table that we drew ourselves, there is a column there for quantity that was sold. Is there somebody who can remind us how many, actually it's even here, how many units we sold? Oh, I'm alone. In January, it's 9,000 that we sold, isn't it? In January, we sold 9,000. You can see sales here. So 9,000 for January. And are you able to see in this case the selling price per unit somewhere? The selling price is given here, 35, isn't it? Selling price per unit is 35? 35. This is January. And then remember February, ladies and gentlemen, we sold how many units here? You can see sales, 11,500. 11,500 times, there is nowhere they are telling us that the selling price will be changing. But if I were to be an examiner, I'm a very rough examiner, I'll tell you that the selling price in February will go up by 10%. Just to confuse you. Because if you get a bad examiner, trust you me, and you're a girl, for example, you've gone in this case here to that exam room with all the makeups, in this case here with, high-heeled shoes, the kind of harassment you can get from there by the end of the exam, you may go home, while walking, in this case here barefoot, isn't it? And the tears, in this case, you have wiped away all the makeups. If you're not studying, of course, but if you are studying, everything shall be fine. Everything shall be fine. So then are you able to give me these numbers? January 315,000, isn't it? So January 315,000, and then February 402,500. And now with your permission, I will be able to grab this. That is sales. So from there, you come and give us what we call the marginal cost of sales. So you less the marginal cost of sales. Marginal cost of sales. So, ladies and gentlemen, how do we normally get cost of sales? Anytime they want us to get cost of sales, we normally take opening stock plus purchases. Remember here, we are a producing organization. We're not purchasing. So we stock of opening inventory plus production minus what here, somebody? Closing. So we start with opening. Now, from the table that we did, what was the opening stock in January? 0. How about February opening? 2,000. Do you remember we did valuation of our inventory? We said our inventories, each unit is valued at how much? 35. So are you using absorption costing? Because remember we did the cost cards and the marginal costing, if I'm not wrong, we are 25. 25 or 27? Was it 25 or 27? But now we are doing marginal costing. That's why we have said you less marginal cost of say, and the whole inventory here was going for 25, isn't it? 25 as well there. So the first one here will be 0. This will be 2,000 times 25, isn't it? Remember we did our whole inventory valuation, isn't it? 50,000. Is that okay? Yeah. And then, ladies and gentlemen, apart from opening inventory, right here, opening inventory. So shall be able to come and say, add what here, product? Add production, isn't it? So we add the production. So add production. So production, how many units were produced in January? 11,000. In January, we had 11,000. How about units produced in February? 9,500. And do we know the valuation of our produced units? Remember, we normally value produced units and inventories in the same way. And if it's marginal costing, then the unit you produced were what? 25. 25. So in this case here, we have 25 there. We have 25 like that. Don't vary units produced at in terms of material cost. Don't split them up because these are complete unit. You are taking up every marginal cost. So are you able to give me these numbers? 275. So 275,000, yes. 237. 237,500. Yeah, thank you so much. And then now lastly, we shall come and say, less what here, somebody? Closing in inventory. Less closing inventory. So closing inventory, January, how much? 2,000. January units were 2,000. At what rate? Remember, inventory and production, we normally value them at the same. And because you're using marginal cost, so you're valuing this at 25. 25. February closing was 0, isn't it? Yeah. For revision, I can just say times 25. So then this gives me 50,000, right? This gives me 0. Remember, I'm supposed to subtract. So please take care of these 3 numbers. Always take care of those 3 numbers. Take care of these 3 numbers. Take care of them. So you're taking here opening inventory, you add the production. So you take 0 plus this minus this, you give me the MOCS, marginal cost of sales. Marginal cost of sales. So remember, to get marginal cost of sales, you take opening, you add production, you less closing inventory. So January, what do we have? Oh, it's only my online students now who are talking to me. They are telling me 225,000. 225,000. How about this one here? So the 3 numbers only, 50,000 plus 237,500 minus 0. So I'm 287,500. 287,500. Thank you so much. Now this marginal cost of sales, you subtract them from your sales revenues. So whatever you've gotten here, you subtract from the sales revenue of January. So 315,000 minus 225,000. What are we getting there? 90,000 here. Yeah. How about in this case here, the second one, 425,500 minus 287,500. How much are we getting? 115,000. 115,000. Is that okay? My online students have also confirmed. So what name do we give to these figures? Remember, in terms of marginal costing, this will be we call them contribution. And because we haven't subtracted the periodic variable cost, we shall call this one gross contribution. Gross contribution. Gross contribution. Now, once you get this gross contribution, now you look for the variable selling. To get the net contribution, look for variable selling. So we have here variable selling costs. Variable selling costs. Are you able to see the variable selling cost, my good students? Today, John Bosco, I can't see you talking at all. It's 1 shilling, isn't it? 1 shilling per unit sold. 1 shilling per unit sold. So meaning that if it's January, to get the total, I'll take 1 times what? 1 times 9,000. 1 times 9,000. Because you see in January, sold 9,000, isn't it? All selling expenses are normally multiplied with the units sold. Units sold. Units sold. So then, ladies and gentlemen, we have here, is it 9,000? 9,000 vis-a-vis what here? Somebody here? Let me actually write up here. Let me actually write up here. So I have my gross contribution. My gross contribution, we have 90,000, and then we have 115,000, isn't it? Yeah. And then we come under less the variable selling costs. So January, it will be 1 times 9,000. February, it will be 1 times. How many units do we sell in February? 11,500. 11,500. Yeah. So we sold 11,500. So then this will be 9,000. This one here will be what here, somebody? 11,500. Yeah, please subtract. That is the only one. So, and then you'll be able to come and give us, ladies and gentlemen, you'll be able to come and give us Yeah, you'll be able to come here and give us what we call net contribution. Net contribution. So net contribution here, I'm being given 81,000, isn't it? 81,000. How about this one here? 103,500. And then now you come and less fixed costs. And they are normally 2 most of the times. Because you see now, all along, we haven't captured fixed costs. We haven't captured fixed costs all along. All along, we haven't captured fixed costs. So we have 2 in this case. We have fixed production overheads. We have fixed production overheads. And then we have fixed what you say? Selling costs. Those 2. So is there somebody who can see fixed production overheads? Anybody who is able to see the fixed production overheads? Remember in marginal? Yeah, remember, the fixed production overheads will either be actual or expected, isn't it? Yeah, actual or expected. Like in this case here, we expected fixed production overhead here to be 20,000, isn't it? Yeah, to be 20,000. So in this case here for January, it'll be 20,000. How about the fixed production overhead in the month of February? The same, because, ladies and gentlemen, that 20,000 is per month. Is per month. Is per month. And then we have the fixed selling cost. Are you able to see the fixed selling cost of 2,000 per month as well? 2,000 per month. So per month, like that. Now you are able to get right away our profit now. You are able to get our profit. You are able to get our profit. So for January, it will be 81,000 minus 20,000 minus 2,000. Give me a number, I write. Give me a number, I write. I want to write something here. So somebody's giving me a figure of what here? 59,000, right? So this is 59,000. How about the second one? Or 50? 81,500. 81,500. 81,500. That is the end of that marginal costing P&L statement. P&L statement. Yeah. You see at the end of the day, J Mugo. Yeah. At the end of the day, J Mugo, here, remember, yeah, the actual, it will be very hard, not unless the examiner tells you. You see, the examiner can either give you the actual rent was 20,000. Yeah. Or he tells you the expected is 25,000. He'll give you one of the 2. So in this case here, we shall use, yeah, the expected, what we expected to in a car here, which is 20,000, like that. And this will make sense to you once you start doing the absorption costing. Any question? Have you gotten some idea now? I know you have done this with your mwalimu. Have you gotten some now better ideas? Better ideas. Better ideas. Better ideas. Because at the end of the day, it's like we are revising, right? Are we not revising, or we are revising? You know, when you're revising, then you should be able to understand this thing much better. Now, if you allow me, I will be able to take you through now what we call P&L, but this time around using what here? Absorption costing. Yeah, absorption costing. P&L using absorption costing. Very, very easy. P&L using absorption costing. So please ensure that you are able to ask questions. But most of the things will just fall in place as we continue. Most of the things. The paper, I'm just doing one illustration question from my old papers here. I even don't know the sitting. So under marginal costing that we have done, so absorption costing, then what is expected of us? Absorption costing. So remember, we have already done the absorption costing card. We have already done the cost card there. Don't forget this. Cost card using absorption costing. Remember, absorption costing is also known as full costing, isn't it? If you remember very well, ladies and gentlemen, here we did take material cost. I'm just repeating, eh? So we took material cost here in the cost card, 4 kgs at 3, isn't it? 4 kgs at 3, which gave us 12. And then we have labor cost. So labor cost, we took what here, somebody? 4 hours times 2, isn't it? Which gave us 8. And then, ladies and gentlemen, we have a variable production overhead. Variable production overhead per unit, isn't it? Which gave us how much there? 5. And then, of course, because this is full costing, we must also bring fixed production, not any other, but fixed production overhead. Fixed production overhead per unit. Fixed production overhead per unit. Remember there, it is 20,000, isn't it? But it is per month. For producing how many in a month? 10,000, which gave us 2. And then at the end of the day, we are able to see a figure of 27. So this is the value. This 27 is what we shall use to value inventory, and then to value units produced. To value inventory and to value units produced. Once you've understood that, then you are at home. So you will be able to come here and do a profit and loss. But first of all, before I continue, especially for my online ninjas, are we together regarding this 27? My online ninjas, I can see physical ninjas here already. They're okay. Online ninjas with this 27? Thank you so much. Thank you so much. Thank you so much. All right. Then with your permission, I will be able to do a profit and loss account using absorption costing. And the absorption costing, we are basically using that method to value our inventory. And then number 2, to value our stock, or rather stocks and production units. So profit and loss account, statement using absorption. Big words for nothing. Very easy. Very easy. Absolute costing. So I will be able to write here my 2 months. If you get a bad examiner who would want you to walk home barefoot, he'll give you 3 months. But even if they give me 10 months, it doesn't matter, right? I'll be able to handle this. So we start with sales. So do we know the number of units that were sold in the month of January? So 9,000, isn't it? And the selling price was 35. Thanks. In this case here, we have Madale. And then we have February. So February is how much here, somebody? 11,500 times 35 selling price. Can you kindly give me these figures? The first one is 315,000. The second one? 412. 402,500. Thank you so much. Thank you so much. Thank you so much, Gadoni. As usual, Gadoni, you are very aggressive, which is very, very good. So in this case here, we less cost of sale. Now I don't use the word marginal. I can come inside here and say, these are the ones absorbed. Absorption costing, isn't it? Absorption costing. So we start, ladies and gentlemen, with opening inventory. Opening inventory. So opening inventory, my good students, if you look at this, the opening inventory, what we have here, opening inventory, you can see month of January, we produced 11,000 and we only sold 9,000. So we have a scenario of what here, closing. So opening inventory is 0, isn't it? But February, you gave me, February opening inventory, you gave me something. 2,000, isn't it? 2,000. So, ladies and gentlemen, January opening inventory is 0. But February opening inventory is 2,000. And because you're using absorption cost, we know the cost per unit. For inventory, which you guys gave me a figure of 27, isn't it? You gave me a figure of 27. You gave me a figure of 27. All right. So then the first one, of course, will be 0, right? The second will be 2,000 times 27, which some online ninjas already have been able to give me a figure of 50 what here? 54,000. 54,000, like that. So that is opening inventory. Now, ladies and gentlemen, after opening inventory, you'll be able to go straight away to the next one. The next one after opening inventory is what we are calling what here, somebody product. So you say add production cost. Add production cost. So our production cost, ladies and gentlemen, will always be pegged on the units here that we produced. The units which we produced in the period. If you look at the units that we produced in the period, units which we produced in the period, hey, they are forgotten. Now, ladies and gentlemen, January is 11,000, February is 9,500. So January is 11,000, February is how much? 9,500. And we know each unit, if it's a complete unit, if it was a ball, it's complete. It must be having labor, materials, overheads in it. So it has everything in the cost card. So do you remember the figure here was 27? Each unit, 27. Each unit is supposed to be 27. Each unit is supposed to be 27. Each unit is supposed to be 27. Masiator, very, very aggressive. Masiator, when you'll be coming to RCM Commonwealth House, I should be able to give you a present. Yeah, also Lizzie. These girls are very, very active. So they're telling me, Mwalimu, the first one is supposed to be 297,000. 297,000. How about the second one? 265? 500. Thank you so much. And then you come and less what here, somebody? Closing inventory. Closing inventory. So closing inventory in the month of January, if you remember very well, January closing inventory was 2,000. February closing inventory was 0, 0, 0, 0. And these are inventories. Remember, inventories are finished goods, Finished goods. So each one of them in this case is 27. We're using absorption costing, isn't it? And this one here will be 27. So then are you able to give me these answers? Somebody called, Junior Ninja. Who is this person who calls themselves Junior Ninja? I would want to give them a present. Junior Ninja, who is this? Because my son is called Junior. Joshua Aura Junior. So he calls himself Junior Ninja. Yeah. The other one is what here? Somebody see? So you subtract. But remember, you must do this for cost of sales. So give me the total cost of sales here. Give me the total cost of sales. Give me the total cost of sales. Give me the total. The first one is 243,000. Total cost of sales. Total cost of sales. 243,000. How about total cost of sales here? 310,500. 310,500. What have they done to get this? They have taken 54,000 plus this minus 0. Yeah. Then this total cost of sales is what you subtract from your sales revenue for you to be able to give me gross profit. Gross profit before adjustments of fixed costs. Gross profit before adjustments of fixed costs. Gross profit before adjustments of fixed costs. So how do you get this gross profit before adjustment of fixed cost? You take the sales revenue, you subtract this 243,000. So the first one I'm being told is 92,000. 92,000. They're telling me that is February. The first one is 72,000. 72,000. And then the second one is 92, right? 92,000. So we have gotten, ladies and gentlemen, here, gross profit before adjustment. Gross profit before adjustment. So we have gotten here gross profit before adjustment of fixed production overheads or costs. Yeah, 72,000, 92,000. Yeah, so now once you have gotten this gross profit before the adjustments, now you need to come and adjust for the fixed cost, where we'll talk over or under absorbed. fixed production overheads or fixed production costs. So over or under absorbed. Under or over absorbed. We'll just do a very, very small statement, really. Very, very small statement. Very, very small statement by the side. By the side. So remember, we have our 2 months. January, February. We have our fixed overhead absorption rate. You guys had given me a fixed overhead absorption rate. If you remember, let me just do it here. Although you guys will do it by the side. So January, February. We have fixed overhead absorption rate. The one you did get by taking 20,000 over 10,000. You guys got 2,2. Do you remember that? Give me the units produced. Units produced in the period. So January we produced how many units? 11,000. 11,000, We am alone. 11,000, isn't it? February we produced how many units? 9,500. So then give me the absorbed fixed costs, absorbed fixed production overheads. Production overheads. Give me the absorbed fixed production overheads. Because in this case, it will be 2 times 11,000, isn't it? 22,000. 2 times 9,500? 19, 190. 2 times 9,500. 19,000. Okay, 19,000, isn't it? Yeah, you guys are following very well. Thank you very much. So then give me the actual fixed production overheads. So the actual fixed production overhead, you told me month, 20,000, isn't it? 20,000. Yeah. Yeah. So then what is the difference? First of all, right up to here before I wrap something, right up to here. But of course, don't squeeze in this in your P&L. The P&L is continuing. The P&L is continuing. This one we prefer putting it by the side over there as a working. Once you finish writing the working, please give me a signal. Say Y for yes. Give me a signal. You should always give your mwalimu a signal. Thank you so much. Thank you so much. So then come here and give me a column for difference. Come here and give me a column for difference. So 22,000 minus 20,000, that gives me. So is this over absorbed or under absorbed? Pata potea. Is this over or under? Not absorbed, but I want you to tell me whether it's over or under absorbed. Because the absorbed was higher. The absorbed was higher than the actual. So this is what we call over absorbed. Sorry for that, because I can see so many guys, even online, are giving me the opposite. So this is over. For January, it's over absorbed because the over, or rather the absorbed is more than the actual. So it's an over absorption. How about this and this? 1,000, isn't it? And now it is what here, somebody? It's under, isn't it? It's under because the absorbed is small. It's smaller. We absorbed smaller. We absorbed little. under. So is that okay? So then you come and take this over or absorbed, over or under absorbed fixed production costs. Now we have the figures. Now I'm so happy. I'm so happy now. I'm so happy. I'm so happy because now what I will do, I will come and say January. So January, we had a figure of 2,000, which was over. So I'll be able to bring and put it here 2,000. So the question is, if it was over-absorbed, do I add it here or do I subtract? So it's either, ladies and gentlemen, in this case here, you tell me add or tell me subtract, or if you know nothing, totally tell me Akiamongen. Akiamongen is a German statement saying I know nothing. Add or subtract. So in this case here, whenever it is over, we shall always add. Over, we add. Ask me why. Even if you don't ask me, I will answer. I will answer. I will answer. You see, this one is an expenditure. So if this overhead is an expenditure and we overestimated when we were subtracting it from our revenue, what happened in this case here to our profits? Our profits in this case here went down. Went down. So to correct the error, we add. Look at this. Assuming in this case here you are subtracting two figures, 100, and then you have here 10. So when you subtract 110, you're getting 90, isn't it? What if in this case here, instead of saying 10, you overestimate this figure and, for example, use what here, 30. So then this 100 minus 30, this will give me what here, somebody? 70. So what is the difference between 10 and 30? 20. And this 20, of course, ladies and gentlemen, because in this case here, I absorbed more. So this is an over-absorption. So if I want to correct this to 70, I will go back and add what here to make it 90. So whenever it is over, you just see, I know in management accounting, at times you see things. Over means a giant. Giant means bigger, increase, add. So whenever you see over, even if you understand nothing, add. Is that okay? Over, add, add. And then now we have February. So February, how much? February is 1,000. And it is what here, somebody? It is under, isn't it? So whenever an expenditure is understated, what does that really mean here? Now, ladies and gentlemen, when it is under like this, what we shall do at the end of the day, we shall be able to go and do what here, somebody subtract? Subtract. So this one, we shall less because it is under. Because when you underestimate an expenditure, then automatically your profit is overstated. Is overstated. Yeah. So in this case here we are subtracting. So put this in a bracket. You put this in the brackets. So then at the end of the day, what figures are we getting here as our proper gross profit now? This is after the adjustments now as our proper gross profit. Gross profit. You can either just write it as gross profit or you say gross profit after adjustments. After adjustments. So after adjustments, this will be 74,000. All right. And this will be what here, somebody? 91,000, 91,000, like that. So, ladies and gentlemen, up to here, are we in agreement? Are we okay? Are we okay? What have we said about over? Yeah, you don't even have to reason. This is a giant, bigger, add. If it's under, smaller, you do what here, somebody? Subtract. Subtract. Now, ladies and gentlemen, then after that, now we shall be able to consider the other expenses. Now, remember now, this is post-production. So post-production, now we bring on board the selling expenses. And there are two. We have variable selling. We have variable selling. So you say less expenses, less expenses, less expenses. Now this is post-production. So less expenses. So less expenses. So we have here variable selling, and a fixed selling. Variable selling and a fixed selling. So variable selling, are you able to see the variable selling per unit? Yeah. So in this case here, variable selling January, you're saying it's 1 times how many units? times the number of units you sold in January, because a selling expenditure can never be associated with production. So selling. So in this case here, January we sold 9,000. 9,000. So then this will give me 9,000, isn't it? And then February, it will be still 1 times how many units do we sell in February? 11,500, which gives me 11,500. These are expenses. Don't again start arguing like, should I subtract? Expenses are always subtracted. After that, we have in this case here, our fixed what now? Selling. We have our fixed selling. So come here, we have our fixed selling. So fixed selling is how much? It is 2,000, not 20. So it is 2,000 in January and 2,000 in February, isn't it? You subtract like that. So now you are able to get what you could call net profit. Is that okay? You're able to get net profit. So net profit will be 74,000 minus this, minus this. Thank you, Faith. So Lizzie tells me that the first one is 63,000. How about the second one? Thank you so much, Lizzie. Thank you so much, Gadoni. Yes? 77,500, eh? 77,500. Thank you so much. So we shall take a break of 10 minutes, right? When we come back, I will be able to tell you what we shall do next, but it's my hope that this revision is taking all of you well. I could see that when you were taught this marginal costing, you really understood it very well. Actually, it's like you never needed my lesson, eh? But it's important that we get to do what here to just revise. So we shall come back at exactly 7:21. Is that okay? 7:21. 7:21. Relax, talk to your friends. Talk to your friends. Talk to your friends.